Good morning, everyone. Dave Downey here with IDA and another edition of Advancing Places. Today's March 15th, or excuse me, March 5th, not the 15th. January and February skipped right through. We're heading towards the last month of the quarter, and we're really excited about today's presentation. So we're going to talk a little bit about capital market insights, the real estate and economic forecast with an extraordinary expertise with Mary Ludgin. And what I think is going to be so really impressive about this presentation, and Mary's going to go at length through quite a bit of information, is it's a full understanding of kind of the real estate economic forecast, not only in downtowns, but in suburban retrofits, small towns, really the entire nature of what's happening with real estate in all sectors, because it's all going to have a relationship to our long-term future and really empower us to start thinking even stronger about what's necessary in our recovery planning. Now, as a reminder, if you are an AICP member, this will qualify for certification maintenance, and you can record those with planning.org. And also, too, while Mary will be making her presentation, please look to the questions pane, pop those in. We'll be sure to get to them when she's complete. If there's anything that that you're slightly confused by, let us know. I can drop in and give Mary a notice that we want a little additional clarification at that point. But for the most part, we're going to have a solid presentation for a good 30 or 40 minutes, and Mary will be just, she's going to blow you away. I know it for sure. But with that, I want to give Mary as much time as we can and jump right into this. So let me do a quick hello. How are you doing, Mary?
Oh, good. Thank you, David.
Oh, fantastic. Coming in loud and clear, and it's a beautiful Chicago skyline in the background through your window. And of course, we can tell you're all in your office, which is a big question I know many people are going to have. But for those who don't know, Mary Ludgin is Heitman's head of global investment research. She is a partner of the firm and holds a seat on its investment and valuation and global management committees. Mary was a global trustee of the Urban Land Institute, and she chaired ULI Chicago's District Council. She served as chair of the Pension Real Estate Association, president of the National Council of Real Estate Investment Fiduciaries, and president of the Real Estate Research Institute. But also, too, recently, Mary has also become a board member of the Oak Park SSA in Chicago, where she resides. So Mary has joined the IDA community as a board member of one of our managed districts there in Chicago. We were talking this morning, the office that she sits in is right inside of the Chicago Loop Alliance, knows Mike Edwards quite well. And with that, Mary, let me turn it over to you and simply say thank you so much for sharing your time and expertise with us today.
This is an honor, everyone. I have spent my adult life thinking about cities, working in cities, investing in cities. My company buys real estate on behalf of big institutional investors like municipal or state pension plans, sovereign wealth funds. And a lot of what we own is in cities. So that's our topic today as I'm thinking about COVID and how it's affecting our economic backdrop in the US. I'll focus on that, but happy to take questions on the globe. Thinking as well about how what we've been doing now for a year is going to affect spatial dynamics going forward. As I'm speaking, you're no doubt looking at this Natalie dressed couple from 100 years ago. You might have figured that out because you could see that their masks only cover their noses, not their mouths. And I'm hoping these people survived the terrible, it was not the Spanish flu, it was the terrible global flu pandemic of 1918, 1919. As most of you know, because you're urbanists, the decade that followed this terrible disease was one of remarkable and intense urbanization. Is that the future for cities in the decade of the 2020s? I will try to address that today with a little commentary on the economic backdrop, capital markets dynamics, and then I'll dig into the property markets that I think are pertinent for people in downtowns, which interestingly enough includes industrial these days. So with that, Lil, if you could advance to the next slide. 2020, amen, it is done. A year like none other. This time last year, we had no idea what lay before us. I look back at some of what I wrote in the early days of COVID, and it's naive and silly, but some of it's also valid. And so I'm hoping my comments today about what lies ahead for us in urban settings are relevant. So first up, to give a quick review, in 2020, a virus took down the global economy, and in the process interrupted what was the longest economic expansion since World War II in the United States. I'm not going to get into politics, but there is no doubt that the virus and how it was handled resulted in an economic disaster that took down the Trump administration and pushed the Biden-Harris administration into power. It also pushed a lot of us into work from home. The image on the left is far more the US household average. By no means everyone lives in settings like this, but more of us do than happens in Hong Kong, which is the middle row at the bottom. And as a result of differences in housing, average housing size, we have seen a return to the office far faster in places like Hong Kong and Tokyo than we have in the US, where many of us have what I have, which is I have a 3-story house plus a basement. So my son is at school in the basement. I'm doing whatever I'm doing on some days of the week in my living room, and my husband is across the hall. But that's not feasible in many places. And so we're looking for a lot of trends to Asia, where the return to the office is happening faster. And then finally, I'll give my biases related to the environment in the bottom right photograph. I was really concerned when it looked as though COVID was going to push environmental issues, climate change, climate risk off the front page because COVID was such a big story. But the climate was not to be denied, and it came roaring to the attention of everyone due to things like the Australian wildfires, the Pacific Northwest wildfires. We're used to them in dry spaces like California, but to edge into places that have historically been wet, I think that brought home to many people the fact that the climate really has changed. More hurricane seasons, more hurricanes in the Atlantic hurricane season than we had letters in the alphabet for, had to go into the Greek alphabet for the last 4 or 5 storms. And then, of course, the toxic plumes from the wildfires it really brought climate change to people's front doors. Next slide, please. There are reasons for optimism on a bunch of levels in 2021. I meant to say this early on. I've been thinking about urban settings long enough that I got my first COVID vaccination yesterday, and that is a huge reason for the country and the globe to have some optimism. As one of my colleagues in the economy and the economics realm likes to say, the stimulus that comes from a vaccine is unlike any other stimulus, more powerful than any amount of money that can be spent as it ripples through consumer confidence, business confidence. It's visible in the jobs numbers from this morning. I think I saw 379,000 jobs added in the month of February, exceeding expectations. It's important to note, though, that there will be leaders in the economic recovery in the US and globally, and there'll be laggards. This recession has been particularly difficult for women. They've dropped out of the workforce in order to teach kids, their own children, in order to handle various aspects of COVID. And we need to get them back into the workforce, otherwise they will be left behind. It's been a really interesting time to watch property operations. They've done much better in many sectors than we expected, with student housing seeing a rebound, for example, and even hospitality, particularly for the leisure segment of hospitality, seeing a bounce back sooner than we thought, and maybe giving some indication of pent-up demand. But retail has been challenged. The business aspect of hospitality that many of you work with, that has been challenged, and of course, senior housing. More on that in a moment. Liquidity and credit exists for a lot of property types. I care about this. My investors buy property using debt, and so we've seen a lot of interest in liquidity in sectors like apartments, particularly suburban apartments that have done well in this downturn. Medical office has done well. There's a lot of hesitancy about downtown office and downtown apartments. You could get loans for them. They're just more expensive relative to their suburban peers, and they might come with specific terms associated with them that reflect the question that people have about what will center cities look like when COVID is behind us. And then finally, what we are saying to our investors that have portfolios that are laden with office and retail, those were typically 50% or more of an investor portfolio by value. Those are sectors where there's been change underway for a long time in retail that was accelerated by COVID, and there's real change that's happening in the office world. So those are more question marks. And so we're going to be seeing a lot more capital flowing into the sectors that did well during this pandemic, that includes self-storage. My guess is you don't want that in your downtowns, but you might want to think about it as a space use that perhaps could complement some other uses, particularly maybe in the upper stories of a building rather than the ground level. We can talk more about that in Q&A. Next slide, please. Okay, from a transaction perspective, we're always looking this. Is there capital? Is there interest? Well, I would tell you through the first 3 quarters of 2020, investor interest was low. Investors were stymied by, how do I underwrite a building if I can't walk through it? Little realizing that their phones were going to become a way that they could see into the corridors of an apartment building or the units of an apartment building. But that took a little figuring out. So it really wasn't until the 4th quarter, and in particular to December, that we saw a rebound in transaction volume, with December being the biggest month ever in the history of this particular series, which begins in the late part of 2001. Nonetheless, the year ended down about a third in volume, and that was mostly about fewer trades in the office realm and fewer trades in the retail realm, given those question marks that I've referenced before and that I'll talk about more in a moment. Next slide, please. So technology is how we have lived, worked, played, and seen our doctors in the course of 2020. It's not how I got my vaccine yesterday, and it was so great to be back in the real world. And I think a lot of us will feel that way once it's safe for us to be there. That's what AMC and its big investor is betting on in the movie realm. That's what student housing investors are betting on, in assuming that while there will likely be some people for whom online education is the solution, it's effective, it's cost effective, but there'll be many others that either want themselves or they want for their kids the real experience of living together with your peers in a college environment. So the question before all of us, though, becomes what's become normal for us and will persist in the last 12 months and the 3 or 6 months that lie ahead before this is all done, and what is going to go back to 2019 levels. So I'll be trying to address that in the next part of my comments. Next slide, please. All right, so we're a suburban nation. I think you know that, and I love Ebenezer Howard's graph on the left. I won't talk much about it, but I'm guessing that many of the people on this call know it well. The pull and the push between urban and country, and the suburbs being that juxtaposition that works for so many people. And it has certainly worked for the US. In looking at that bottom pie chart, suburban areas in the country represent about 52% of where the population lives. That's up from the 33% that stat was in 1960. That being said, what we've lived in the last 30 or 40 years is a really remarkable revitalization of many urban settings. Next slide. So the question becomes, is that about to change? We've been looking a lot at what it has meant as COVID has prompted move-outs from cities, trying to glean whether they are forever or just for now. What we're observing in the anecdotal data before the Census Bureau comes out with more is that it's a lot about people moving to second homes. It's a lot about people moving home with mom and dad. It seems less about a permanent choice for rural or exurban or even suburban over city. That said, there were dynamics I'm sure you've talked about in the IDA. Uh, there were dynamics underway pre-COVID that are relevant. We've got a gigantic demographic cohort in the form of the millennial generation, the eldest of whom are turning 40 this year. This is the period between age 35 and age 40 where people are forming households, they're having children, and in many instances, that means that where they were living pre-children may not work for them as they're raising kids. Urbanists have seen this before. I remember a guy I adored, but not always right, in talking about the future of certain districts of downtown Chicago that had seen revitalization and residential formation in the 70s and through the 80s. And he was talking about, well, what happens when the baby boom, my generation, moves to the suburbs to raise its children? Who will be the urban masochists that want to move in to these spaces? And what we found is generations don't move in mass. They move in households. They move as individuals. And I'm an example. I had kids in my 40s rather than kids in my 20s. When I went to my college 25th reunion, I was pushing a stroller while some of my absolute age cohort were talking about their kids going off to college. And that will likely be what happens for the millennials. So there will be a boost to suburban settings. Many of you represent downtown districts and suburbs. There's a real opportunity because some of these people are going to be craving that walkable style that they had when they lived in downtown Chicago or downtown Boston or downtown San Francisco. So I see an urban planning opportunity for that, particularly as you try to backfill vacancies on your high streets that are not likely going to be filled by the level of retail that you had before. A quick comment, if you don't mind, on that photograph of the moving van in front of the White House. I think that's mocked up art. That's not real. I doubt if that's how the Trumps moved out. But when I created this particular picture, it was November, and I was looking for a moving van in front of a Soho apartment was what I was about to put into Google Images. But up popped the moving van in front of the White House, and I couldn't resist. And I do think it's worth noting that the Trumps moved from Washington, D.C., not to an ex-urban setting, although they own some. They moved to another urban setting, and that's the dynamic that we have been following. The bottom right is anecdotal data. This is Allied Van Lines data, I believe, from it's the middle of the summer, so I need to update this. But people querying for a moving van in San Francisco, where were they looking to go? Well, they were looking to go to other urban settings by and large. Seattle was first. Austin was second, a growing urban setting. Chicago, my hometown, a third. New York, a fourth. Boston, the fifth, and Denver, the sixth. So I do think that there are going to be people that have left forever. They have gone to the suburbs. They'll like the suburbs. That's where they will live their days out. There are others that are doing it for the child rearing period, and they'll be back. At the same time, I look at my 20-somethings. One of them just graduated from college, lived at home for the first 6 months after the pandemic began, and she just got 3 months free on a downtown apartment in downtown Chicago with 5 other people, right? There will be, the rents are down, and that means there'll be migration. The migration will include people that were having longer commutes, moving into center cities for the walk to work lifestyle they are expecting to be a part of the post-COVID era. And there will be people that are going to take advantage of our big cities being on sale. Next slide. I'll go through this pretty quickly. We were trying to typologize the impacts to property that had happened in the COVID era. And we cracked the property types we invest in into 4. Those on the left are places where the pandemic and the recession that followed accelerated existing trends. 3 of them were the winners. Industrial, data centers, and single-family rentals are true winners in this environment. Retail, by contrast, many are saying 5 years of change got compressed into 1 year as people shopped online more for a broader array of categories than ever before. So retail was hurt. The other three were helped by what happened over the last 12 months. The next category over, these were sectors that had a really big hit, and there's some changes ahead. Hospitality is meaningful to everybody on this. I think that there will be a resumption of leisure travel first, business travel second. I just heard about a colleague that's gone to the Nordics to investigate some investment opportunities. That's the first transatlantic travel that I've heard about. I, for one, haven't been on a plane in a year, and I'm a 4 million miler for American Airlines, right? So I've been shut down. I don't know what my first trip will be. From a business perspective, I am looking forward to post-vaccine, some expansion of the borders that I see. Senior housing hit really hard by the downturn, and lots of questions about its future. I would say their demographics mean its future is bright, but it needs to be well operated, and it's coming to your downtowns where we're seeing that seniors thrive in settings in which they can walk to the library, they can walk to get their groceries, they stay alert longer. And so this is an opportunity of one of those uses to backfill. Student housing, it survived. I'll talk more about that in a moment. Within the next category, these are places that saw some impact in the spring. In particular, our medical office portfolio, we had dentists asking for rent relief, eye doctors, because people couldn't get to see their dentist or their eye doctor in the early days of the lockdowns. They're fine now. Storage had a great run, and it's a sector we're heavily invested in. It is not glamorous. There is no granite or marble on the front of a storage facility. You may not want it in your downtowns, but there may be a complementary role to other uses in your downtowns. And then finally, apartments. The impact was meaningful, particularly in downtowns. I think they're coming back, and I'll talk more about that in a moment. And then office, which is relevant to all of us. It has the murkiest outlook of any of the sectors. And Lul, if you could go to the next slide, that's what we're going to talk about next. This is a slide generated by JLL. They've done a marvelous job of tracking dynamics among their clients and foreseeing what's likely ahead. And I think they've got it just right. There's a lot of simplistic thinking out there that an increase in work from home is going to be a decrease in demand for office space. That is certainly true for some firms. Some firms have let their office lease expire. They've gone to a completely virtual format. It will work for some of them. Some of you might remember Marissa Mayer, who was the CEO of Yahoo. She saw things differently than her predecessors, and she invited or demanded the employees to come back to the office. I have a feeling we're going to see some CEO change in the aftermath of this recession that leads to a reversing in this idea that firms can get along without office space, can be completely distributed in their workforces. There are dynamics within firms, excuse me. There are dynamics within firms that vary in how they're going to see their space needs going forward. It's dependent upon culture. It's dependent upon what these firms do, how much collaboration is necessary. Let me just pause and say, I'm in my office today for a bunch of reasons. I'm in the office about 3 days out of every 5 now, which is what's expected to be the path going forward for many firms. I hope that means I get to keep this wonderful space because it's efficient for me to be able to leave things as they are and pick them right back up when I get back rather than having to pack up at the end of the day. But I'm here for a couple of reasons. One is I can count on my internet connectivity from the office in a way that I can't from home. I've had that horrible experience of a technical issue that happens when I thought I could get away with an 8 a.m. presentation. But the demand on Comcast, my internet service provider, must have been too great. And there I was, frozen on screen. So I wasn't going to do that today. But I'm also here because of the efficiencies that I find as somebody that manages people from age 22 up through 66. There are efficiencies that come out of my being able to quickly see 5 people as I walk down the hall, even with a mask on, and ask them for an update on this, give them an assignment, bring 3 of them together. That's what happens, those creative collisions as well. They don't just happen in the conference room or on the Zoom call, they happen on the way into the conference room or the way out of the conference room. So what does that mean for space demand going forward? Next slide, please. It's a little unclear. What is clear is that last year was an immensely stressful time for offices. What I'm showing you here, the gold line is vacancy. This includes sublease space as well as whatever the opposite of sublease space is. What you can see is the vacancy has ticked up about 200 basis points in a year, and it's back to close to the highs that we saw in the aftermath of the global financial crisis. This is at the metro level, aggregated up to the national level. The red is space demand, the red is completions, and the blue is space demand. So what you saw was typical of late cycles, late economic cycles, a meaningful amount of new supply delivered in 2020, just as space demand went the wrong direction. Some of that will turn around. There will be some reversal of this give back of space. Some people that put sublease space on the market are likely to pull it off. So I would expect some improvement in the demand side of this. That said, there will be a period during which, as happens in the aftermath of every recession, employers try to curtail their costs by limiting the amount of space they have, giving it up entirely or shrinking their footprint. So we're thinking that there is going to be broad pressure, upward pressure on the vacancy rate, even as firms breathe out the space to get the 6 feet of distance per worker. But we're thinking that there's going to be a lot more instances of less assigned space, more people assigned to collaboration space, and that's likely going to put downward pressure on the amount of space the average office occupier occupies. Next slide. From a rent perspective, this is an interesting story. We're seeing the Sun Belt was the beneficiary of COVID dynamics. Boston creeps in here, but basically the parts of the country that did the best over the last 12 months from an office perspective were places where people can drive to work. They weren't worried about their commutes, even though coronavirus is really not transmitted by people standing on the Chicago L car, especially when the cars were so uncrowded. But that was the perception. People didn't want to ride in elevators. They didn't want to ride on transit. And so those markets like San Francisco and New York City and Seattle were hard hit. By contrast, the places where people work in 3-story buildings, where they work on 1-story levels, where they drive to the office, those did better in this environment. Is that forever? I don't think it's as simple as that. That being said, there are some demographic dynamics underway that have meant we're seeing a lot of migration out of high tax states like my own to lower tax states as people think about retirement, as companies are focused on the bottom line or focused on trying to figure out how their employees can be in a position to buy a home. So that is putting pressure on some of these traditional higher cost locations like Chicago, New York, Seattle, and San Francisco. Next slide. I think the important point here is that, as I said earlier on the overview office slide, a lot of supply delivered in the course of 2020, exacerbating weakness in center cities. So what you're seeing here is the green is net absorption or space demand over the last 12 months or the last 4 quarters, and that was negative, with the only exception being Raleigh-Durham among the big cities and San Jose. And then on the right is the amount of supply that was being delivered. This is typical of the early aftermath of a recession. Our cities are seeing buildings delivered into them. It brings down the value of the real estate. It makes it more affordable for tenants. So we often see tenants migrating into center cities in the aftermath of recessions, or moving within center cities, doing flight to quality, it's called, moving to higher cost, historically higher quality buildings that are available at a bargain price. Next slide. This is not an original slide. I did not create this, but I think it's relevant to all of us. So I'll give credit. It was put together by UBS last spring, and it is a focus on what's likely to happen in one really interesting district of London, London's West End. But I think it's got pertinence to all of you that have mixed use districts, office, retail, hotel, residential, where the dynamics are bad in the short term. The vacancy rate, which is the line, is expected to go from 3.3% to 11.5% by 2022 due to some move outs, due to consolidation of space to smaller footprints, due to an array of different factors. But they're expecting vacancy to get back down close to where it was pre-pandemic as space gets converted to other uses. We saw this in center cities around the country during the last decade. In Chicago, get this, the statistic that one of my colleagues put together for me was the net inventory of office space at the metro level declined between 2010 and 2018 as space was converted to other uses, and we weren't yet seeing meaningful amounts of new construction. So those conversions included small floor plate, high-rise office, converted to hotel, converted to for sale condominiums, converted to for rent apartments, converted to senior housing. That will happen again. And so all of you need to be thinking about, are there impediments that would create this problems for developers interested in converting obsolete uses to in-demand uses? I don't think we'll see as much hotel conversion of old office spaces because I think we're pretty long hotels in many office districts or many downtown districts. But I do think senior housing is a logical conversion. Apartments are a logical conversion, condos, a logical conversion. And there are many things I haven't thought of. Medical office, lab space, there will be such conversions. So look at your zoning ordinances and figure out if you're doing anything that would get in the way of that vitality producing kind of conversion that lies ahead. Next slide. I'm going to go a little faster. So on the apartment side, what you're seeing here, these are this is the national level. So it includes suburban as well as urban settings. Then I'll dig down into the urban. So you're seeing that occupancy fell in the course of 2020 as we had a lot of new supply delivering, similar story to the office market, and demand was depressed. Demand is depressed in recessions. People move home, they move in with roommates, they're uncertain about their jobs, so they do cost-cutting things. And then typically we see a surge of demand coming in the aftermath. That's not exactly the forecast for 2021, but we are expecting a really solid year in 2022. Real Pages, the forecasting source, but it coincides with what my apartment team thinks is going to happen. So apartments will recover broadly. Next slide, please. Part of that recovery will be a change in this particular trend. So what you're seeing here, this is year-over-year revenue growth through November or December. I can't recall which. I think it's through December of last year. So that blue line, the ugly line that shows negative 4.5%, negative almost 5% in revenue growth, that is high-rise urban apartments. It was a dreadful year to be an owner of a high-rise urban apartment. We saw people move out to cheaper places. We saw them move home with their parents, as I've already mentioned. Is that the future? I don't think so. I think a lot of those dynamics that were in place in the 1920s that caused urban settings to be appealing are in place today. Millennials are aging into their suburban period, but there's a large generation, Generation Z, that is coming. They're graduating from college. They're like my 22-year-old that just signed up for 3 months free on a 12-month lease. The urban setting will get more and more appealing as our museums reopen, as concert venues reopen, as we can go out to dinner again, go out to lunch again. There will be vitality in our cities again. By contrast, I just want to point out The low rise is that teal color, and they saw rent growth during this downturn. So there's a whole lot of talk about how suburban settings are in better position than downtowns. Part of that relates to the fact that downtowns have seen so much construction, so that exacerbated the revenue decline. Well, NIMBYism has dominated our suburban settings. So you all need to be thinking, those of you in suburban settings, you need to be working with those that are scared of density, when we know that density is an important thing for supporting local retail and other local businesses. So figure out how it is to get the naysayers behind you. I got his testifying before the Oak Park, Illinois Village Board, arguing for an upzoning from 10 stories to 20 stories, a building that would be across the street from a 20-story building. And I got hissed by my neighbors over having the temerity to suggest that a high rise near the L was a good idea. Work with your naysayers and help make your downtowns more viable, I would say. Next slide. I'm going to jump over this because I've been long-winded. I think broadly demographic dynamics support garden, mid-rise, and high-rise apartments, and that relates to the fact that we have more people across different age groups renting than we have had in the past. Some of them are doing it because they've sold the big house in the suburbs and they're going to try renting in downtown for a year or two. Maybe they'll buy, maybe they won't, but we're seeing more people in their 60s and 70s as renters than we have historically. Next slide. There are new places that are flourishing, single-family homes for rent, probably not so relevant for you all, but I'll just tell you it is a part of how the millennial generation is dealing with not having the money to amass a down payment to buy, but wanting to go to a setting in which the school districts are good. So you're going to potentially be seeing pressures for single-family rents in your towns for those of you that have suburban downtowns. Next slide. Okay, retail is probably the other most relevant topic, so I'll spend most of the rest of my time on the retail sector. The chart that you're seeing here is e-commerce through 2020 third quarter. We saw a huge spike in the share of retail sales happening online versus the gold line is the in-store bricks and mortars sales. They bounced back in the bricks and mortars, but still had a terrible year. What COVID did was to cause people to be frightened of going out to shop, and it got even people that were reluctant to use Instacart, it got them using Instacart. It got people interested in using online services for things they'd never contemplated before. Some of that will stick. Some of it won't because people are so eager to be able to get back and see one another. This is visible, that pent-up demand is visible in those municipalities that chose not to enforce bans on in-restaurant dining, or people were actually wanting to do this in the height of the second wave. That was a little sick from my perspective, but at the same time, it's a clue about just how social we are and how much we are looking forward to getting some aspects of our pre-COVID life back to what they were before. What COVID has meant is the inevitable painful shrinking of the retail universe. A lot of the retailers that were in expansion mode pre-COVID were experiential retailers. That includes Dave and Buster's and restaurants. It also included gyms. And so these were not entities that were in expansion mode during COVID. There will be some demand. Some of them will accelerate sooner rather than other. I happen to be a believer that the head of Gap is right, that there will be a surge in apparel, which was not selling during COVID other than sweatpants. I have a feeling many of us have new bodies after COVID, the COVID-15, we're gonna need new clothes. So I'm counter to the general view. I think apparel, where I always want to touch and feel the quality of apparel before I buy it, I think that will come back. And that was evident actually in the amount of buy online pickup in stores that we saw, where was up like 270% year over year in August. For people like me that are, I think there's an environmental cost to delivery to the home. I'm not an Amazon user, my husband is. I want to see something. I want to get it when I want to get it. And so I've done some BOPUS, and I've done a lot of being in the stores with my double masks on. So next slide. This is, for those of you that are interested, this is looking at the COVID dynamic with e-commerce globally. That spike up in the middle of the chart is the COVID year, and then there's a forecast going forward. Even in cultures like Japan and Spain, where there hadn't been much penetration of e-commerce, there was an upsurge in that. Likely gonna fall back, but to grow from that higher base. And so e-commerce is a reality that all of us need to recognize. That said, what the COVID era did was to reinforce the role of physical stores for the most nimble of retailers. That includes Target, that was able to allow people to shop in store, allow them to shop online and get home delivery, and to allow for pickup in store, buy online, pickup in store. That proved out the role of the physical store. It still is the cheapest place for a retailer to make a sale, even with rent and with employee costs. It's much cheaper than free delivery and free returns for them. So there are many retailers that closed and will not reopen during COVID, but those that survived this know the role of physical stores. We just, as you'll see on the next slide please, we just have way more, sorry, one more slide. We just have way more retail, be it enclosed regional malls, which are the most challenged, or high streets. We have more retail than we can fill. Those of you that live in older urban areas, drive down some of the arterials, and you're going to see the old corner store that got converted to residential 80 years ago or 50 years ago. There will be more of that. You are going to be asked to approve conversions. And I would say, don't be waiting for a retail surge, for growth in store demand. Go with the adaptation that you need in order to be able to fill these spaces with some level of vitality. Next slide. Of course, retail vacancies will include final mile delivery. This is not what you want in your downtowns, but there will be uses that are more interesting for downtown settings. Next slide. I'm going to jump over industrial because I'm running low on time, but you know the story. It's done extremely well during the downturn. Even though it's not much of a job creator, it is an economic engine many cities are looking at as part of their future. Next slide. Student housing, I'm not sure how pertinent this is for you, but our conclusion based upon, look at that, rents rose in 2020 versus 2019. And that's a statement to us that students still want the in-person experience, and that will come back to them soon. Next slide. I'll skip this and go on to the next one, Lil. Thank you. Storage, I'm not sure how relevant it is to you, but it's a big part of institutional portfolios, as unglamorous as it is, and it will be more going forward. So don't say no to it, just put it in the right place. Next slide. Senior housing, the silver tsunami is what's being depicted on the right. This is the aging of the US population. If we were in China, I'd be showing you the same slide. Korea, the same slide. So seniors are growing as a share of the total population. And what we're seeing, where we like to buy senior housing, is in urban settings where people are able to retain as much as their home ownership life into their assisted living life as possible, the freedom to move, the freedom to be vital for as long into their life as they can. Next slide. Medical office, this is a great use. We love it as investors, and maybe jump to the next slide, Lil. This is a statement about where people would like to have their healthcare needs attended to. They're okay with hospitals, 23% of them like that, but 77% of them prefer a location away from the hospital. And medical office, those of you that already have it in your districts know, people go to shop or eat before or after a doctor's visit, even a dentist visit. So it tends to complement the uses already in your district. So we urge you to think about, if you need to change zoning in order to make it feasible, even for ground floor use, you might want to think about it. Next slide. I mentioned this earlier. This is looking at the composition of my institutional investor base around the globe. The US is on the right. About 55% of their portfolios are office and retail. We're going to see a pivot away to this. More urban apartments as that snaps back, more senior housing in urban areas, that will be part of it. Next slide. In fact, yeah, perfect. I thought that was my next slide. I'm going to conclude here and say that we have 15 minutes for Q&A. I hope that if I've said something that offended you, that you think is wrong, you'll challenge me on it or ask questions to clarify what I've just said. Over to you, Dave.
Thank you so much, Mary, and so much information to unpack. Do want to invite everyone in the audience to put questions in the pane. But maybe a couple things that we can start to explore directly. You know, in the past, Mary, you didn't talk about it today, but specifically, but you've talked about office as a service rather than space. Could you talk a little bit about what that means from kind of an investment perspective?
Yes. So one of the dynamics that was on view in the run-up to COVID was co-working space. And here you had entities like WeWork that were taking 5-year leases, 10-year leases, and turning around, building out the space and leasing it to tenants on a 30-day lease effectively. There are problems with that model. Often what WeWork was doing was buying high cost space and renting it out for even higher costs. But as demand fell, that model fell apart. But what it did do for tenants was to say to them, especially in weird periods like the aftermath of a recession, we can be flexible. If you only need this for 30 days, we can be flexible and you can rent it for as long as you need, rather than the traditional norm in the US for downtowns to have 10-year leases. Office tenants hate 10-year leases. They're being bound into something that doesn't suit the volatility, particularly of their business model. So I do think, to the extent that co-working spaces can be adapted to allow for them to not be structured with these arrangements that aren't good for the office owners, but where the office owner perhaps is the operator of the co-working space, that they're going to be a fine element, particularly in the uncertain period just coming out of an economic downturn.
And there's a general question, kind of the outlook of this pandemic-driven recession compared to the Great Recession. When we came out of the Great Recession, downtowns tended to recover much quicker than other parts of the city. Do you foresee that possibly being the same? And then just in general, how might this recession compare to the last?
Sure. So one thing that's different this time is the amount of new apartment supply that was in the pipeline before COVID hit, and that has either just delivered or is about to deliver. Much of the residential that was delivering in the run-up to the global financial crisis was for sale. A lot of this is for rent, and there's a lot more supply overhang being delivered now. And what that's going to mean is cheaper rents. It's not as great for an investor unless you can buy on the expectation of those cheaper rents. But I do think it's going to be quite attractive to a broad group of people that are going to get this walk-to-work lifestyle at a cheaper rate than they could have expected. So I think not great for us as owners, but could be really great for downtowns in attracting the recent college graduate, attracting somebody that may have gone to college in the downtown, didn't think they were going to be able to afford to live and work downtown in their early career. They may be able, there may be a lot more of that. And that will help offset the migration to the suburbs of the older millennial generation.
Yeah, you actually touched on something I was curious about with regard to the difference between for sale urban dwellings, condos, versus what was recently, everything coming online was rental only. And from a business perspective, I imagined property owners were looking for that recurring revenue. As we're looking at migration out, sometimes because of the opportunity to, get into an equity position and owning your place, do you envision that will, I don't know, shift back towards more for sale product in the downtown? or are we pretty much going to stay at the rental kind of schemes that have emerged?
I would say I think the rebound in the condo market is a few years off. What COVID did in some instances, especially the social justice protests last summer, that changed some locational decisions that some baby boomers were making as they were thinking about, do I sell the house in the suburbs and come downtown, or do I go to Phoenix? Some of them went to Phoenix. So I think depending upon what kind of a summer this is, if it persists, for as much as I understand the social justice protests, they were not great from a center city perception perspective. So I'm hoping we can avoid that this summer, because otherwise you start to have a trend. I think the oomph out there is going to be in the for rent side. I think that's where younger generations have been willing to take risks on cities before. They did it in the 80s in settings in which the only grocery store was a 7-Eleven. They've got a far better built out landscape now. I have a feeling that they're the most dominant renter, or the most dominant element of the rental profile or the residential profile, and that's going to help apartments first.
And so maybe the last couple of questions dealing maybe with re-envisioning some of this space.
Yes.
And I immediately have like two questions. One, what are the lending institutions? What's the capital market really thinking about? And if we have, property owners who are saying, yes, I need to convert a portion of what was office to something else, are they going to be able to find the capital to make that change? And then we can talk a little bit more about what that change might,
Yes.
what might be most strategic for downtown organizations to even advocate for, as you alluded to several things in your presentation. But what about capital?
So on the capital side, I think you've got sophisticated, large, traditional lenders like banks. There will be some bank capital that will flow into regeneration projects. But I think a lot of the money that was raised in private debt vehicles, my firm makes loans. We raised capital from institutional investors and we make loans a lot of times in settings where something's being turned around. I think we're likely more the source. We cost more than a bank does, but I have a feeling that's the capital that will understand and be willing to take the risk. Regeneration strategies are really risky because you never know what's inside the walls. You never know what you're going to get as you're retrofitting. From an environmental perspective, I love it because it's taking care of the least carbon intensive process, but that's an aside. So I think there will be capital to do this, especially if it's conversion of a share of a building rather than changing the use of the entire building. So I have a feeling that there will be capital aplenty for these rework strategies.
And you alluded to several things, whether it was student housing, senior housing, professional services. I think we're all struggling with the expected decline in retails. And so re-envisioning our storefront, if you will, or our sidewalk economy is all in play. Where do you think is kind of some of the best first moves from all of those things? You even mentioned storage on upper floors, certainly not sexy, but it reminded me of the in Times Square, One Times Center, which has all the billboards. I understand has no occupants because it's all the servers. Now, I don't want our buildings to be like that, but it did give me a little kind of indication. Well, if there's a couple stores of floors of storage, and we have buildings that can really withstand weight loads, maybe that's at least an economic opportunity. But where do you see the greatest kind of retrofit or reuse strategy that downtown organizations might want to be advocating with their property owners?
Mike, I haven't given this a lot of thought. So the off-the-cuff response is, I think there will be great residential potential. And so residential being the umbrella that includes the for rent residential across the age spectrum, the senior housing version of it, and potentially the medical office version of it. I didn't give you the demographics of the medical office, but the the two prime users of medical office space are people under 16 and people above 65. And you know the story of the 65 and above, 20,000 of us turn that every day. So there's just gigantic demographic pressures for that. And our medical office set in settings that are multi-use, it's a great concept. And hospitals are not where people want to be, particularly. They'd much rather see their doctor in a setting that isn't in the hospital. So I have a feeling between residential and medical office, those are areas that are going to come back soon.
So maybe we'll go a little off script here, Mary, and I know that you're currently the chair of ULI's Sustainable Development Council, I believe it's called. And
Center for Sustainability and Economic Performance. How about that for a mouthful?
Sustainability and economic performance. And you also alluded a little bit to kind of the inequities that were existing in some of our urban centers. From both a, say, climate perspective, as well as perhaps an equity perspective, how great is the opportunity that we have perhaps coming out of COVID to address some of those challenges on both climate and equity from your other passion area?
Yeah, so not to give my politics away, but I kept hoping that Mar-a-Lago would flood during the not to wish ill on anyone, but during the hurricanes of the last 5 years, because I do think that climate change should drive policy. It should help us get out of our cars. It should help us realize that for the health of the planet and the health of people, a walkable lifestyle, this 20-minute downtown idea, I think is really compelling. So I think COVID made so many of us realize just how fleeting life is. Live it in a healthy, wise way would be my suggestion. Now, I appear to have frozen. Lil, yeah. Can you hear me still?
We can hear you perfectly.
Oh, good. I'm glad to hear. So I think the other element is this recognition that we can use stimulus money to address social justice and simultaneously help to make our infrastructure more ready for higher sea levels, for hotter summers, colder winters, more snow, more rain in the wrong places, or more water in the wrong places. That we can do that in a job creation program. And so getting double bang for the buck. And we need to be smart about it. Many of our lowest income neighborhoods are underserved in all sorts of ways, and they're often the areas of greatest climate risk. So let's focus on job creation in these neighborhoods that can help with flood treatment, flood prevention, as just one example of trying to be smart so that each dollar we invest to help get the economy back right is used as wisely as possible and as justly as possible.
Well, Mary, I want to thank you so much for spending time with us. I'm sorry your screen had frozen, but we have a great image of you nonetheless. Your insights into the real estate market and what to expect in downtowns is certainly going to be beneficial in all of our members and the way in which they develop their recovery planning and interface with their property owners and businesses. So I thank you for that. And I really appreciate the work you're doing with regard to sustainability and equity as well. From all of us here at IDA, again, want to remind everyone, if you're AICP, to submit for your credits. And next week, we'll be digging into branding strategies for your districts. I think rebranding and or thinking about your brand post-COVID will be an imperative in trying to rebuild our urban centers. Mary, thank you so much. I hope you have a wonderful weekend. And to everyone in the audience, please enjoy the rest of your day. Take care.
Thanks so much, David. Bye, all.